Hello, I'm Dominic, Hobson, co-founder of Future of Finance. My guest today is Loretta Joseph, who is a Fintech Advisor and policy influencer, currently based in Mauritius. Our topic today is programmable money. Hello, Loretta.
Good morning. Good morning, good afternoon, or good evening, depending where you are.
Thanks for joining us.
It's a pleasure.
So let's begin with a basic question. What is programmable money?
So programmable money is effectively tokenizing money. So when Bitcoin came along in 2008, and it gave us the concept of digitalizing money. Ethereum, which is this protocol that much of this DeFi at the moment is based upon, uses this programmable money. And it is, I guess, a good way to describe it is it's a tokenization of money in some form. So, and it uses the internet's mathematics to create this money, as opposed to money we have in the normal financial systems, which is usually a paper bill stamped by a central bank governor, and apparently, or was, backed by an asset, something like gold, before 1971.
So we don't need banks.
In DeFi, definitely not. It's called decentralized finance, and it's a movement, I guess, that uses decentralized networks to perform old financial market products that used banks but no longer need banks.
So if we were to try and explain to somebody who hadn't thought about it before how it differs from traditional money, what would you say?
So in traditional finance, traditional money, it's permissioned. It's money is currency is printed by a country or a central bank. There's a need for KYC AML when we're dealing with this money. They're closed source, what we call their closed loop systems. They're censored. They're legacy systems which have been around a long time, and they're quite slow. So in the world of DeFi, we no longer need an intermediary because it's based on the blockchain technology. So effectively, DeFi does all the functions that banks used to do, but they don't require a bank. So we can do things now peer-to-peer without using an intermediary like a bank to perform all those functions that banks and financial institutions did, like lending, borrowing, trading derivatives, trading dollars, I guess, in traditional forms, savings, debt, credit. All the things that we used to do in the old world, we can now do in the new world with a flick of a button and without the need for an intermediary to do so.
So the main advantage is we get rid of the intermediary, the trusted intermediary, which has stood between us and all sorts of financial contracts and financial instruments for centuries now.
So yes, in a way, it's permissionless finance. What we're talking about in traditional markets is permissioned finance. Think of this as permissionless.
Okay, now, why do we need this innovation now?
Well, I don't think we actually needed it now. It was just a point of the innovation has been moving so rapidly since the inception of Bitcoin in 2008. When Ethereum came along, what Ethereum added on top of Bitcoin, because Bitcoin is effectively just the digitalization of money. Ethereum came along and they said, well, if we can digitalize money, why can't we digitalize every other asset class? So innovation has been moving at a rapid speed over the last 6 to 7 years. I think what came along this year has certainly been the pandemic. The use of using traditional finance has become much harder for a lot of us. As we're stuck in little rooms around the world. So there's been a big push, I guess, to create this parallel system, not out of innovation per se, but also out of a need. So a lot of these DeFi projects have been around for a long time, but they've been boosted on, I guess, by the fact that now with the blockchain protocols, you have scalability, they are immutable, they're interoperable, and they are much user-friendly than they were, say, 6 years ago.
Now, who's going to issue these currencies? Obviously, a fiat currency is issued by a central bank. Even a central bank digital currency, as the name suggests, is going to be issued by a central bank. So who's going to issue these programmable forms of money?
So I look at it like playing a Pokemon game using Lego creatures. It will be issued by the network. So mathematics will be issuing this programmable money. And it's effectively like a series of Legos built on top of each other, because the underlying protocol, as I said, is Ethereum. It's what we call open source. So anybody can go in, anybody can use the protocol, and then anybody can build a dApp on top of it. So in the traditional world, when we think about using an internet, using your phone, you have apps. We can build apps on top of the internet. So now on top of these new protocols, we can build dApps. So people are creating new forms to trade money, to save, to offer credit, to trade derivatives, to be asset managers. All the number of things can now be created by a number of people just using the open source technology that's underneath it. Millennials are very good at this. I don't think the baby boomers have caught on quite yet, but it's certainly a movement, if you look at it just this year, that has been taken up considerably by the millennials and the generations under them that understand, because they have technology in the internet, that they can now effectively do everything that a bank does, but just between each other.
Now, if anybody can issue a programmable form of money, will the central banks not get bothered by that? After all, they were very concerned about Libra. What do you expect the impact of this to be on monetary policy?
I think in the short term, it's not going to be that much of an effect, because DeFi is still in its infancy. It's important to note that money means different things to different people. So what is money in the traditional sense? It's a store of value. It's a means of payments. It's a legal tender. In this new world, in this parallel system of permissionless finance, money means different things to to different people, but it's not currency per se. I don't think anything in DeFi is going to replace a fiat currency, and I don't think that's the intention. And I don't think central banks will worry about it until it starts to impact the banks to the point where it's a concern. So at the moment, the DeFi markets probably, and it's only done on one protocol at the moment. So understand that you can only do decentralized finance on the protocol of Ethereum. I think over the next 5 years, you will see other protocols start to develop, which will be bigger, greater, have much better scalability, more operability, more general public use. But at the moment, because it's limited to the Ethereum network, it can't scale very well. There is probably $2 billion locked up in it. So if you're looking at it on a relative value GDPs around the world, it's not much, it's not significant. But I'll just regress, because 5.5 years ago, when I first started to talk about Bitcoin and central bank digital currencies and stable coins, these were less than 1% of GDPs and problems that we need to worry about in the global economic system. Move on now 5 years, and things like Bitcoin, if you look at the price of Bitcoin, it's an all-time high today. These things are becoming very, very large in momentum, very large in the amount of money that's been put into these things. So I think Bitcoin now in the network has got more than $1 trillion. So while this innovation is still in its infancy, we as the regulators are trying to figure out what it is, what it does. After our last conversation, I think I was saying that regulators are concerned because anybody can now be a bank. So all I need is a wallet address. I can give you money, programmable money. I can be an asset manager for you. I can do all those things. But in the traditional world, I'd have to go through a whole lot of KYC, AML processes. And if I went to buy something on Amazon, like something to stand my phone on, I would have to give my mother's name, my dog's name, and every other part of history to do that. All I need now is a wallet address, and I can perform all those functions with another person without an intermediary in between. So that these parallel systems, I think, are going to challenge the traditional finance world. Not now, but given the rate of innovation that I've seen since I've been in this space for the last 7 years, it's going to become a problem in the next couple of years. So I think regulators are also grappling with how do we regulate something that doesn't have an intermediary? because regulators per se in the banking world, they have the central bank, we have securities regulators, we have commodity regulators, we have a number of regulators that effectively protect the consumer and the investor because they have the intermediary to regulate. What do we do when we take out the intermediary? That's a question I think regulators are really grappling with at the moment, and that's going to become much more prevalent, I think, over the next 18 months.
One final question. Can you give us some practical examples, some practical use cases? Will people be using this, for example, to buy houses and motor cars?
No, it's more, I said, it's decentralized finance. So I think along the lines, there's 3 major protocols or application dApps that have been developed on top of this in the last 6 months that have raised significant amounts of money. I'm talking over hundreds of millions of dollars. So there's one called the MakerDAO. That's effectively it's pegged to the US dollar, so you can move in and out of the MakerDAO coin into US dollars. So that's effectively FX. The other one is Compound, which is an interest rate protocol. So it's effectively a savings account. You can put money into Compound, and you can put more crypto or more tokens into it. You will earn more interest on it. That's a very interesting one. And the other one I think is Uniswap, which is which we call a decentralized exchange. So Uniswap is the equivalent of having a decentralized NASDAQ. So you can trade anything on this decentralized equivalent of NASDAQ without having to have a formal exchange, which is centralized or live somewhere. So they're 3 very good examples, I think. And that's why the momentum of these is picking up, because they're disrupting what we consider to be traditional means of lending, borrowing, trading securities on an exchange, disrupting them on their head and doing it very quickly, and upsetting regulators a lot, because when we're not used to these systems, we're not used to these decentralized networks to perform old financial market products, which generally were done manually and by people. And these protocols, you've got to remember, they're trustless and they're transparent, so we don't need an intermediary. By what I mean trustless is that we don't actually need to rely on a third party to trust that these networks work. We trust mathematics. So this is really turning traditional finance on its head and twirling it around and then throwing you off into the ocean. So these DeFi is going to be very interesting. As I said, at the moment, just because it's on Ethereum, I'm not so worried about it. We as derivatives traders have traded derivatives markets for many, many years. I was a derivatives trader. I think what will be a concern is when traditional derivatives traders like myself enter these markets and start using the skills and the tools that we learned in traditional markets, and we're going to do it a lot better than the average 16, 17-year-old or 25-year-old kid that's playing in these markets now. Then it becomes interesting when you get the institutional traders like myself and many other people getting into this parallel system, which is very different from the system that we're used to, but doesn't have any of the rules and regulations that we've always had to be compliant with.
But just looking to the very long term, very briefly, do you envisage this eventually being used in everyday transactions?
Yes.
Programmable money being used to do everyday purchases, our grocery shopping, or as the examples I gave earlier, buying cars or houses, things people do with their lives, as opposed to financial products like savings and investment?
Definitely. I mean, if you look at the moment, there's one of the biggest cryptocurrency exchange in the world is called Binance. Binance have their own coin, and it has been now used to transact to go and buy a meal in a restaurant or buy food. Bitcoin was never meant to be a payment system. Bitcoin was built because the people that built Bitcoin were very worried about security and privacy. Now, privacy is not secrecy, but it was built and it's slow, it's clunky. You don't really want to go and use a fraction of a Bitcoin to buy a coffee, to be honest, because it takes a long time, it takes a lot of energy. Ethereum came along. It's still quite slow and clunky. I think to get a transaction done takes about 4 to 5 minutes. In Bitcoin, that's 10. But some of these other protocols, and there's a very interesting one coming out at the moment called Polkadot, and a protocol built on top of Bitcoin called Lightning, which are making the throughput of these transactions as fast as anything you're going to see in Swift. So yes. So we've always used the traditional rails of the the SWIFT payment mechanism, which banks use between each other. These protocols will definitely be used in under a decade. I think will become very normal practice for the young, especially the young. Anybody that has a mobile phone and likes to have instant gratification is going to find much more benefit or much more use out of using these new ways of using programmable money than, say, the baby boomers.
Loretta Joseph, thank you very much. That was fascinating.
Thank you very much for having me. It's always a pleasure.